Good morning and welcome back to Blockware Live. I'm your host, Mitchell Askew, and today we are going to be discussing the American takeover of Greenland, the threat of tariffs that President Trump is yet again talking about, and what all of this means for the economy, for financial markets, and for Bitcoin. But first, make sure to smash the like button, share the stream, and follow us on YouTube, on X, on Rumble. We've got a lot to talk about today, a lot to unpack here. We're going to be live for the next 45 minutes to 60 minutes or so. And there's a lot of levels to this conversation, so make sure to stay tuned. And if you missed our stream last week on Thursday, we're going to be building upon a lot of the things we discussed there because I believe this move to try and take over Greenland plays into the bigger picture dynamic of the Trump administration, which is this: all of their moves have been geared towards solving this $38 trillion debt problem. And I think this is no different. Granted, there's a lot of different levels at play, and I'm not sure entirely if the strategy is working based on what the market is telling us right now. So there's, like I said, there's multiple levels. We'll unpack all of it in this show. Make sure to leave a comment down below. Tell me what you enjoy. Tell me what you agree with, what you disagree with. But before we get into that, and again, our featured story of the day is this American takeover of Greenland. Are we going to actually acquire Greenland and make it a 51st state? Potentially, we'll see. There's a few other things we're going to discuss today. We're going to talk about if we have enough time for it, granted, because there's a lot to discuss with Greenland. But if we have enough time, we'll talk about Mark Moss and the perpetual Bitcoin machine that he calls it. He went on What Bitcoin Did last week, and I don't want this live stream to be a What Bitcoin Did watch party, although there's great content there. But we will discuss some of the things he discussed in that episode. We're going to watch a clip. We're going to break it down because a lot of it aligns with what we've been saying here at Blockware of the past 6 months or so about how you can literally get the government to buy Bitcoin for you. And we're going to unpack that towards the end of the show. We also may talk about this new New York Stock Exchange blockchain trading platform that they've been talking about. They made a press release yesterday that you may be able to trade equities on the New York Stock Exchange 24/7 on a chain, settle on stablecoin. Interesting stuff. We'll get into that towards the end of the show. And without further ado, we can get into the featured story. Although, one more thing I want to unpack here is this is going to sound crazy, and you'll be like, what does this have to do with Bitcoin? But the weather, there's supposed to be an extreme cold front hitting the United States across the Midwest and the South later this week. And I think that's going to be our featured story for Thursday's show because this is going to actually have a very big impact on Bitcoin mining. And we'll unpack all of that on Thursday, but it's definitely something to keep an eye on. Right now, it seems like it's going to be snowing across much of the northern hemisphere, across much of the United States, which is where a majority of the Bitcoin miners are domiciled, is in these states. So it's going to be interesting to see how that story develops over the rest of this week. Again, we'll talk about that on Thursday, but we've got a lot to unpack there. And personally, as someone who lives in the South, I don't get to see snow and ice very much, so it's kind of Armageddon in my area whenever something like this goes down, right? We don't have enough infrastructure to actually deal with ice and snow as it happens, right? Because it's so rare, it doesn't make sense to invest in all of that. So when it does, it's chaos. So I personally am selfishly looking forward to a bit of a snow and ice storm, but major implications for Bitcoin miners. We'll talk about that on Thursday. Additionally, Blockware is publishing a report this week on everything in markets for 2026. So, Blockware premium subscribers, they've received much of the content we're about to publish. If you want early access to insights, you can become a premium subscriber. Go to newsletter.blockwareintelligence.com. All of the things we're going to discuss in this report have basically been shared with our premium subs. It's only $10 a month. We've got thousands of subscribers already. For basically the price of a couple cups of coffee, you can get access to premium market research ahead of time, be ahead of the curve. But for those who don't want to fork over the $10 a month, we're going to be sharing our 2026 market forecast this week. Make sure to follow us on X, Substack, YouTube, everywhere. We're going to do an in depth breakdown of that report on this show, likely next week. but we're going to publish the full PDF this week, breaking down everything that happened in markets in 2025, why Bitcoin stagnated when many were expecting a blow off top, and then what to expect in 2026. What are the on chain supply dynamics looking like? What's going on in the macro world? It's a very detailed and high level report. So make sure to check that out. Again, premium subscribers already had access to this information as early as December. So if you want to be ahead of the curve, then $10 a month, you can subscribe to our premium newsletter and receive all of the insights ahead of time. But with all of that out of the way, let's get into the featured story, which is this American takeover of Greenland. Should the United States take over Greenland? Because that is the story right now, and markets are reacting to this. And as we unpack the market reaction, I want to lay down kind of a base level point, which is markets are forward looking. Markets are not responding to headlines directly. They're res- they're responding to implications of the headline. A good way to think about this would be I used a baseball analogy in the last show, so I'll use another one this time. Is if there's a 3-0 count, you got 3 balls, no strikes. Level 1 would be, oh, of course, the pitcher needs to throw a fastball, right? He needs to throw a straight because he doesn't want to walk the batter. Fastball is going to be the most accurate pitch. And so that's like level 1, right? That's the headline. Pitcher's going to throw a fastball. But the meta game or the game theory of it is the batter knows a fastball is likely coming, right? So he can sit there, wait for the fastball. He has nothing to lose because he doesn't have any strikes. He can get a pretty easy base hit knowing the fastball's coming. So level 2 becomes, well, the batter knows the fastball's coming, so the pitcher's actually going to throw a curveball or a changeup, right? And this is what markets are responding to. They are reacting to the second level there, or even the third, fourth, fifth level of the implication of the main event. So the main event is, hey, Trump is threatening tariffs because he wants to take over Greenland, which we'll discuss if that's actually a good idea, if the United States should do this, why they would want to do this, etc. But based on the market's reaction to the second, third, fourth order implications, that can give us a lot of insights into whether or not something like this would actually play out. So, level 1, Trump wants to take over Greenland. Why? Well, if you watch Thursday's show, which, to repeat myself, the main idea that we discussed there, and this is the main idea of the Trump administration, is there's $38 trillion in debt. How can we get that down? Well, they've tried a bunch of different things, but ultimately what they're resting on is currency debasement and growing the economy faster than the debt. If they can increase the production of goods and services and grow GDP faster than the interest on the debt compounds the debt, and further deficit spending also compounds the debt, if they can grow the economy faster than the debt, it's basically not problem solved, but problem relieved. And so Greenland is filled with a boatload of natural resources. Lots of oil, lots of what they call precious earth materials, right? It's things you use in semiconductors to build chips, data centers, all this stuff. It's a safe haven or you know, a global haven of natural resources. So from that level, it makes perfect sense why the United States would want to take over this land. In addition, we already have a Space Force base there. And Greenland, while it's somewhat of a sovereign state, is actually under the rule of Denmark. Now, Greenland operates domestically. They, write their own laws, whatever. But from a geopolitical kind of nation state level, they're under Denmark's rule. Denmark is in charge of all their military defense, that sort of thing. And so they're kind of this quasi sovereign, quasi, you know, p- property of Denmark type entity. So it's not like, if the United States went and conquered a different country like Canada or Mexico or whatever, where they're their own sovereign people, their own sovereign nation state. Greenland is a little bit different in that regard. And so they have all of these natural resources. And as the United States tries to position itself to be a faster growing economy, the main method through which that's going to happen is, of course, artificial intelligence, right? If you can get a bunch of omnipotent, all knowing, all powerful robots that can work in factories and can do all the white collar work and can just produce mass amounts of goods and services at basically little to no marginal cost, that's going to actually allow the economy to grow faster than the debt, which the debt is growing quite rapidly, I may add. About 2 years ago, it was just around 30 trillion. Now it's almost 40 trillion. In 2 years, we've added $10 trillion. I don't know how long it took to get to the first $10 trillion, but I can imagine it was probably over 100 years versus now in just 2 years, we've added 10 trillion. So the debt's growing fast, but can we grow the economy faster? That's the primary objective with taking over Greenland and accessing all of those natural resources. We didn't mention it last week on Thursday, but this is also the idea with Venezuela, right? The United States went and ousted their president, and basically it's at the present moment seems to be US territory. There's a lot of oil there that can stimulate the economy, that can get prices down, allow the economy to grow, et cetera, et cetera. So strategically, when we analyze the scope of events and policy from the Trump administration, right? You had Doge, you had the big beautiful bill, you had the tariffs last year. You've had all these things that are designed to address the debt problem. Taking over Greenland perfectly fits in with that idea, right? We want all these natural resources to stimulate our economy. Let's take it over. Now, the market reaction has been very telling. So first, markets were obviously closed yesterday on Monday. So Bitcoin is the canary in the coal mine, right? It is the only 24/7 globally traded asset with billions of dollars in daily trading volume and liquidity. So it always reacts first to news events. Because the markets can be closed, Bitcoin is always open. And so Bitcoin initially dropped from about 95K to 93K. So that gave us a little bit of inside baseball into how traditional markets would respond when they opened this morning. And the response has been alarming if you are the Trump administration. So the equity market is down as expected, but additionally, the bond market is down. And the long end of the bond curve, and this is very important, this is going to be kind of the base of this discussion and really the signal that we can derive from all of this chaos. The bond market continues to fall. The bond market, which is the quote unquote risk free safe haven asset that is the bedrock of our current economy, is US debt, US Treasury bonds. The 10-year Treasury bond, you loan money to the government for 10 years, that rate that they pay you, that is the risk free rate, right? They can always pay you back because they can always print money to do so. And so most of the financial calculations in the world are derived from the 10-year rate, right? Am I going to invest in this equity or this business or this asset versus lending money to the government and getting this guaranteed rate? So the treasury bond market is, of course, the most important market to watch in the world. And I'm going to pull up the screen share here and you can see for yourself exactly how the treasury bond market responded. It hasn't been good. So the bond yield is up. Oh, it peaked over 4.3%, went up basically 20 basis points overnight on the back of this tariff news. And interestingly enough, this is basically what happened last year. So I'm going to zoom out the chart here. Again, this is the 10-year bond rate. I'll flip really quickly to the 30-year bond. Same thing, right? It peaked almost over 5%. And if we zoom out to the 1-year view, this is what happened last year. So like I mentioned on Thursday's show, the first order of business for this administration, explicitly from Trump and from Secretary of the Treasury Scott Bessent, was to get the 10-year rate down. They can borrow, if the government can borrow at a lower interest rate, that's obviously going to help the debt problem. Moreover, it's going to allow for more economic stimulation with the 10-year rate being down, right? The opportunity cost to buy government bonds is lower. So, therefore, investors, entrepreneurs, builders are going to invest in other opportunities. Additionally, mortgage rates would therefore come down, more activity in the housing market, etc. So, they want the 10-year rate down. And in theory, and I think this is what they were going for last year, and perhaps even to some degree right now, if they can cause uncertainty in the markets, in theory, that would cause a bid on the 10-year, which would get the 10-year interest rate down, right? If there's uncertainty in the markets and the economy and people don't know what's going on, they're going to say, hey, I don't know what's going on here. So I'm just going to buy this safe asset. I'm going to buy government bonds. I'm going to take the guaranteed 3, 4, 5% yield, whatever it is. And then I don't have to worry. I don't have to evaluate companies, look at their P/E ratio, evaluate their cash flow and their earnings during a very turbulent and uncertain time. So they'll say, hey, I'll just buy this safe, the quote unquote safe asset. But what we saw in 2025 when the Trump administration very purposefully caused uncertainty within the markets, right? We had tariffs, they're on, they're off, they're on, they're off. They're 100%, they're 10%, right? Just completely jerking the economy around. Nobody knew what was going on. And so by deliberately creating uncertainty, the idea was the 10-year rate would come down. But the total opposite happened. People, investors, they actually left 10-year bonds and went to a more certain asset, which is gold. Now, as a Bitcoiner, I would argue that Bitcoin is the most certain asset, and it one day in the future will be the thing that responds positively during times of uncertainty. Right now, that's not how it trades. Right now, it trades as the thing that responds negatively during uncertainty. So during this tariff tantrum that they call it, Bitcoin dropped. Then we catalyzed this bull market in gold that went throughout pretty much all of 2025. And ironically, and this wasn't the administration's intent, I don't believe, but the 10-year bond yield increased. 10-year bonds, 30-year bonds, 20-year bonds, they got sold off. And so when we look at the chart, the initial response going into the tariffs was actually the 10-year rate was starting to come down, right? This is January 15th. Trump, I believe, took office on January 20th, which coincidentally enough is actually 1 year ago today, to the day. The 10-year rate was starting to go down, and they got it as low as under 4%, right? But then it just rocketed back up. And now it's still been kind of just treading water in this 4% range. So the primary mission from the get-go to get the 10-year rate down has not been working. And what we're seeing today with the bond market reacting again to news about potential tariffs is not good. It's not a good sign for the 10-year rate. It's not a good sign for the administration and their goal of getting that 10-year rate down. Now, are tariffs actually going to happen on, they say, 8 different countries in the European Union? Maybe, maybe not, right? That's kind of the point. The point is uncertainty. Create uncertainty in the market. It's not working. Additionally, tariffs, as we saw last year, they're really just a negotiating tactic. By being very extreme and saying we're going to do tariffs on all of these countries if they don't give us our demands on Greenland, it's going to make those countries more likely to capitulate to some of the president's demands. This is The Art of the Deal. I've never read the book, to be transparent, but the summary I've gathered is that you kind of start with these hyperbolic, very extreme negotiating points. Now, to me, it seems this would only work if you're in a position of power, right? If you are the United States president, you are in charge of the strongest military in the world. I wouldn't recommend trying this tactic if you're applying for an entry level job, right? Saying, hey, I only want, you got to give me 250K a year, fully remote, give me a Bentley on my sign in. I don't think that's going to work very well in that negotiation. But when you're the president or when you're Donald Trump, business mogul, real estate mogul, and you do negotiate from a position of power, it makes sense to really over request on your demands when negotiating and then kind of see what you can get from there. And that's clearly what the tariffs are, right? He's saying, hey, we're going to tariff all of these countries at very high rates if you don't give us what we want, which is Greenland. Now, he's not being totally authentic in that, right? Because he's not actually going to tariff all of these countries at extremely high rates. That would likely cause a bunch of chaos in the economy and markets, and I don't think it would go over well. But by threatening to do that, he can be more likely to get what he wants, which is Greenland. So the high level and the summary of all of this is that the 10-year rate is not responding well. And the more the 10-year rate continues to increase, the more likely it is that the president has to kind of either rein in the rhetoric or outright say, hey, you know, come to a deal, right? Strike a deal on Greenland. The pressure is on when the bond market is falling. Again, I'll say that again. The pressure is on when the bond market is falling. The bond market not reacting very well to this news. Moreover, the clock is already ticking, right? Because in 2025, when we had the tariff tantrum, which I wish there was a better name for that because it sounds more degrading, as if you're critiquing the strategy, which from a first principles level, I actually kind of like tariffs. I think it's going to be good for the American people, the American job market. I think it's good that we should be producing more physical assets within America. We shouldn't be outsourcing the production of physical goods and services to the rest of the world from a strategic standpoint. So I don't like the term tariff tantrum because of the negative connotation, but that's just what it's called, right? We had this tariff tantrum last year, and the bond market didn't do well. The equity market didn't do well. But 2025 was not a midterm year. 2026 is. And so I highly doubt the president is going to want the markets in hot water, in turmoil, going into the midterms later this year. So I don't think this instance of tariffs will have quite the negative impact on markets as 2025. We'll see. We'll see how long he holds the line on this. I'm not confident that he will hold on to it for a very long time. So I think this will be ultimately kind of a bump in the road, slight headwind on a short-term basis, but I think throughout the rest of this year we're going to see risk assets do well, specifically Bitcoin, specifically US equities. So with that said, let me switch back to the widescreen view and we'll get into our next topic of the day, which additionally, I want to make one more point on this. Let me go back to the screen share. Here's a chart, and I want to give a shout out to my friend John Har, John _@ Swan on X, because he brought this to my attention. And this chart here, what this shows us is the Fed's balance sheet based on duration of the Treasury bond. And here specifically, we're looking at only bonds greater than 10 years. So 10-year Treasury bonds, 20-year Treasury bonds, and 30-year Treasury bonds. And this story hasn't been talked about enough because throughout all of the past 3 years, when the Federal Reserve was allegedly in quantitative tightening, right, their balance sheet, it was technically shrinking. The amount of long-term treasuries they were holding actually increased. That's what this chart is showing us here. So since 2020, obviously you had a massive surge during the tsunami of QE during the coronavirus lockdowns. But even during this period of quote unquote QT, where the Fed's balance sheet was shrinking, the amount of long term treasuries they were holding was actually increasing. So over the past 3 years, while the Fed's balance sheet was shrinking, they've been acquiring more and more long term treasuries. What does this mean? Well, it means, for one, the bond market is in even more of a fragile state than we might have initially suspected, right? So the Federal Reserve being this kind of buyer of last resort for treasury bonds, providing this passive support to the long end of the curve over the past few years. Imagine where the 10-year rate would be if they weren't doing that. Now imagine where it might be headed in the future as they really truthfully engage in QE. Now, rather over the past few years, right? Here's what was going on. You had the treasury market issuing a bunch of short-term paper, and then you had the Fed letting that short-term paper roll off their balance sheet. So we're talking, 2-year bonds, 1-year bonds, 6 months, 3 months, right? Because the treasury did not want to refinance for 10 years, 20 years, 30 years at the higher rates. So they're saying, hey, all of the money we're going to borrow to finance the government and to fund our operations, we're going to do so with the short end of the curve, with very short maturity debt. Meanwhile, that debt was also the form of debt that the Fed was allowing to roll off their balance sheet. Because if you look at their balance sheet as a whole in the aggregate, it was technically shrinking. But because we looked at the long end of the curve and their holdings of 10, 20, 30-year treasuries was increasing, therefore we can reasonably deduct their holdings of the shorter term stuff was decreasing. And this explains why we got an inverted yield curve in 2022. Historically, an inverted yield curve, which means the interest rate on short-term debt is higher than long-term debt. Historically, this signals a recession. And on a elementary level, right, this wouldn't make sense. Why would you get 4% lending to the government for 2 years and 3% lending to them for 10 years, right? Because in theory, the risk is higher the longer the terms of the loan. So historically, this has signaled a recession is coming, right? Because investors, they want to pile into the quote unquote risk-free asset. But what happened is we never got that recession. The yield curve inverted, but we never got the recession. And this really explains why. Because the Federal Reserve was allowing the short-term paper to roll off their balance sheet, at the same time, the Treasury was issuing much more heavily on the short end of the curve. All of that resulted in an imbalance in supply and demand on the short end specifically, while the long end was being supported through one, less issuance of long end debt from the Treasury, as well as continued accumulation of long end debt from the Fed. So what we're seeing is these two different arms of the economy, of the banking system, of the fiat system, however you want to describe it, these two separate arms, the Treasury and the Fed, kind of working in tandem to support the bond market. Now imagine again, let's pretend that support doesn't exist. The 10-year rate would be much higher. But I think we're going to see this support working in tandem together, even more so to support the long end of the curve, because we're not seeing the market organically bid the 10-year rate down, even during times of uncertainty. And so what does this mean? Well, ultimately it points to more QE, right? The Fed is going to have to support the long end of the curve even more, which is more liquidity in the system, which is bullish for Bitcoin and bullish for equities, for gold, for pretty much everything. Pretty much any hard asset is going to perform well during QE, which that's where the puck is headed. The puck is headed towards more quantitative easing in 2026 and likely 2027 and throughout the rest of President Trump's term. Again, we discussed pretty in depth on Thursday about Jerome Powell, the position he's in, and the expected dovish Fed chair to come later this year. I think what we're seeing in the bond market today specifically kind of points to all of that. So that's what's going on today. That's the main idea behind Greenland taking over that, the tariff, how the market is responding to all of this. And so from there, we're going to pivot to a bit of a different topic, which I'm super excited to talk about. And let me get back to the screen share because we're going to watch a short clip from the What Bitcoin Did podcast. And then I'm going to elaborate on what they're talking about here. So in this clip, we've got Mark Moss, who's an entrepreneur, business owner. Most people in the Bitcoin world know who he is. And he's talking about borrowing against Bitcoin. You know, when should you borrow against your Bitcoin? How should you do it? What should you buy if you borrow against your Bitcoin? And this idea, borrowing against your Bitcoin, has received somewhat rightfully a toxic reputation within the Bitcoin world, right? Because you had a lot of people borrow against their Bitcoin at the top in 2021 and they got totally burned. But borrowing against hard assets isn't inherently a bad idea. If you do so in a risky manner, i.e., borrowing against Bitcoin after it just went up from 3K to 60K in a year in 2021, that's probably a bad idea. Borrowing at a high rate where you have to pay it back within a year, probably a bad idea. But inherently, borrowing against assets is what the ultra wealthy do. It's what billionaires have done. It's what multimillionaires do to become billionaires, right? You don't sell your assets, you borrow against them. You take out liabilities in fiat, in a depreciating currency, and you buy hard assets that go up against the depreciating currency. Meanwhile, your collateral, which in this instance would be Bitcoin, also goes up against the fiat liabilities. So conceptually, it makes a lot of sense if you understand the depreciating nature of fiat currency. And so I think Mark in this clip provides pretty good practical applications for how the layman can do that. What the layman should do when borrowing against their Bitcoin. So I'll click play. We're going to watch for a couple minutes and then I'll get into kind of further analysis.
For example, with Bitcoin, Bitcoin is volatile. So if I borrowed at the top of the market, so based off of 4-year cycles or looking at on-chain data, if I borrowed like 80% at the peak, there's a chance it could drop 50%. I'm going to be up 160% LTV, and I'm going to get either liquidated or margin called.
Yeah.
So I have two things. Either one, I have the income or cash reserves to cover a margin call if that comes, or I borrow less LTV, right? So let's say that I understand market cycles and we're at the 200-day moving average, which is historic low. I could borrow 60, 70%, probably pretty safe. We're at the peak. I'm probably only going to borrow 30, 40%.
And when you're borrowing that, you think people should be looking to borrow against their Bitcoin to buy more Bitcoin?
No.
Or they should be
the first thing I want to do is I want to get rid of my taxable income.
Okay.
I want to buy an asset that will wipe out my taxable income because that's instant money, right? So we talk about Bitcoin miners. So I could borrow against some of my Bitcoin. I could buy Bitcoin miners. The Bitcoin miners wipe out my tax debt and they give me more Bitcoin. Then next year, I take some of the newly mined Bitcoin and I borrow against that and I buy more miners and I wipe out my taxes again. And it becomes a perpetual Bitcoin machine. The government is buying my Bitcoin for me.
How about that? The government buying your Bitcoin for you. And I'm going to unpack everything he's talking about here and why this makes a lot of sense. First, let me take a hit of the water. So, when you're borrowing against your Bitcoin, as Mark said in this clip, the risk is liquidation. The risk is the value of your collateral drops below the amount that you owe for the loan. Very basic example. You post one Bitcoin as collateral when Bitcoin's $100,000 for nice round numbers, and you borrow $50,000 against that Bitcoin. If Bitcoin drops 50% from 100K to 50K, now you owe 50K and your collateral is only worth 50K. So you're forced to sell that Bitcoin to pay back the loan. That's worst case scenario. This is the thing you want to avoid when borrowing against your Bitcoin. So what can you do to avoid that? Well, there's a few basic things you could do. One, don't take out too much against the collateral, right? Let's say you're worried about a 50% drop in the price of Bitcoin. Maybe not when it's 100K, but when Bitcoin's 200K or 250, right? This is when a lot of people start to think about borrowing against their Bitcoin after a massive bull market. They see all of this wealth that has been accrued on paper and they don't want to sell their Bitcoin because they're greedy, right? It's human nature. I get it. And so they're saying, hey, maybe I should borrow against my Bitcoin so I can buy this new house, buy this new car, send my kid to college, do whatever without actually selling my Bitcoin. So step one is don't borrow at extremely high loan to value ratios if you anticipate that Bitcoin could drop. So if Bitcoin's 250K, maybe don't take out a 50% LTV loan. Instead of borrowing 125K against your one Bitcoin collateral, maybe just borrow 70K, right? Whatever. So that's step one. Don't borrow too much. Know your limits. Know how much you could stomach a drawdown before being forced to sell some of your collateral, because that's what we don't want, right? In a hypothetical world where you never had to sell the collateral, this always makes sense, right? Because fiat is going to continue to depreciate, Bitcoin is going to continue to go up against fiat. Your collateral will grow faster than your liability. And you actually see this play out in the mortgage world, in the real estate world. So, real estate has a benefit for borrowing in that you very rarely see a margin call. For example, if you took out let's say you had a fully paid off home, you took out a HELOC, and the housing market actually went through a turbulent time. You saw not, a 2008, 2009 epic level of collapse in the housing market, but a dip. You don't get a call from your banker or your HELOC lender saying, hey, you got to sell your house right now because the collateral is on par with the loan. They don't do that. They allow the market to recover. As long as you make the payments on your HELOC, you're covering the interest, you're covering however much of the principal you've agreed to in your loan terms. They don't care if the value of the collateral dips below the outstanding balance on the loan because they know over the long term, over the life of the loan, that collateral, the real estate in this example, will end up being worth more than the loan. And so they're willing to, see times where the collateral drops below the loan balance as long as you're making the payments. Unfortunately, you don't have that in the Bitcoin world yet. I do believe products like that will hit the market over the coming years, but as it stands, if you're borrowing against your Bitcoin, if the collateral value drops below the loan balance, you have to liquidate your collateral. So, step one, don't take out extremely high LTVs, especially when the market is feeling a little frothy. Step two is you need cash flow to service that loan. If you borrow against your Bitcoin and buy more Bitcoin, you're not getting cash flow. You're not getting an asset that produces income that you can then use to pay the payments on the loan, to pay the interest. A great example is 2025. If you borrowed against your Bitcoin in 2025 and you'd say, hey, I'm gonna, short fiat, right? I'm gonna try to do this Michael Saylor play where I take out fiat liabilities and I buy the hard asset. Great on paper, but when you have a year where Bitcoin goes down and you have to pay the loan back in a year, you're SOL, right? You made out poorly on that decision, poorly on that trade. But if you, instead of buying Bitcoin directly, bought a cash flowing asset that was correlated to Bitcoin, well, you're getting cash flow to service the loan as you go, allowing you to potentially refinance at the end of the terms. And in addition, if it's exposed to Bitcoin like a Bitcoin miner, then you're going to still have that long Bitcoin exposure. You're still going to be weak the short currency or short the weak currency, which is the dollar, long the hard currency, Bitcoin in the form of your collateral, as well as the Bitcoin miner producing Bitcoin every single day. And in addition, by buying Bitcoin miners with your borrowed funds instead of Bitcoin directly, you get immediate capital return through bonus depreciation. So this is something that people don't really think of when they think of buying Bitcoin miners. They think the entire capex is a sunk cost. You're never getting that back. Basically, you can wipe your butt with it, right? But that's not true. One, the miners retain some amount of resale value into the future. And two, your opportunity cost is not the price of the miners. It's the price of the miners minus the tax savings. For example, if you bought $100,000 worth of Bitcoin miners and your effective income tax rate, combining state and federal, let's just say 30%, and you buy 100K worth of miners, you're immediately getting 30K back, right? So you would say, in theory, if you bought 100K worth of miners, your opportunity cost is one Bitcoin, right? You could have taken that and gone and bought one Bitcoin. Actually, because of the 30K in tax savings, your opportunity cost is only $70,000, zero point 0.7 Bitcoin. Again, assuming Bitcoin's at 100K to make the math easy. Your opportunity cost is 30% lower because buying the miners, if you are mining in the United States and you're a United States citizen, you get 100% bonus depreciation for that tax year. So immediately lowering your taxable income, that's immediate money back in your pocket. Buy 100K of miners, 30% tax rate, 100% appreciation. You save 30K right off the bat in taxes. That's 30K that would have gone to the IRS that is instead working for you. On top of that, the Bitcoin miners are producing cash flow to cover the terms of the loan, and you're generating more Bitcoin. And then 2026 ends, 2027 begins, you have another tax bill. Well, you can do the same thing again. You can buy more miners, offset your taxable income even more. And while all of this is going on, your collateral is, if we're right about Bitcoin and we're right about fiat currency continuing to depreciate, your collateral is increasing in value against the loan, against the loan balance. You borrowed 50K, your Bitcoin was worth 100K, your Bitcoin collateral, now Bitcoin's 150K. Boom. Your collateral increased against the value of the loan. So this is kind of the high level of the perpetual Bitcoin machine. I love that name because this is really, I think, going to be one of the ways that you can increase your Bitcoin stack, grow your wealth in the rest of this decade, in the 2020s. This play likely won't exist forever, right? After 2040, the amount of Bitcoin mined on a regular basis is going to be quite small unless Bitcoin on chain transactions just become the norm, right? If we're seeing everybody transact on chain on a very regular basis, talking large financial institutions settling with each other in Bitcoin. If that happens, and Bitcoin's $1 million, sure, this play could be around, 2 or 3 decades from now. But for right now, this is the opportunity, I think, of the remainder of this decade, which is taking advantage of these depreciation laws and acquiring more Bitcoin, maintaining positive cash flow to service fiat denominated liabilities. And I know that's a mouthful, but the 80 IQ left side of the bell curve idea is really simple. Short the weak money, long the hard money. And this is the best way to do that. You can call it the perpetual Bitcoin machine. You can call it borrowing against your Bitcoin. You can call it intelligent leverage, whatever you want to call it. This idea, we're seeing it in all areas of the Bitcoin right now. Short the weak currency, long the hard currency. And this is not a new play per se. It's new to Bitcoin, but it's not new to assets in general. This is what the billionaires have been doing. They take out liabilities against the weak currency, they buy the strong currency. They're short dollars, they're long real estate, long equities, long private equity, long gold, right? Because those fiat liabilities become weaker over time. And this is what the government is doing. Why do you think they have $38 trillion in debt? Because they know the real value of that debt is going to go down over time because they can print more currency. They will print more currency. $38 trillion seems like a lot today. 10 years from now, it's going to be less. And so if the most powerful entities in the world are executing this type of strategy, take out fiat liabilities, invest in yourself, invest in cash flowing businesses, invest in your economy, buy hard assets, why aren't you doing that? Something to consider. So again, weak currency, you need to short that, take liabilities in that. Hard currency like Bitcoin, hard assets like Bitcoin miners that generate cash flow, give you tax savings, you want to be long those throughout the regime of depreciating fiat currency, which has really been the theme of this decade from an economic standpoint. High inflation, extreme currency devaluation. This is why all assets are going up, right? In 2025, does it really make sense that gold and equities made all-time highs simultaneously? It really doesn't, right? Because gold is the safe asset. Gold is what people buy. It's what your grandma buys when she doesn't know what's going to happen. It is the thing investors buy during uncertain times. They buy gold. But equities are the things they buy when the market is good, when things are certain, when the economy is booming, when we're doing well, right? They buy tech stocks, they invest in the economy and cash flowing businesses. QQQ and gold are making all-time highs at the same time. What do you make of that? It's a bad denominator. The dollar is the thing that is falling. What we're measuring these assets in, that's what's flawed. Asset is an equation. It's asset divided by USD. Bitcoin per dollar. Shares of stock per dollar. Ounces of gold per dollar. It's the denominator that's broken here. The dollar is what is broken. And so when you start pricing your life in other things, when you price assets in other things beyond dollars, that's where you can get a bit more of an honest glimpse into how assets are performing. Because it doesn't make sense for gold and equities to make all-time highs in tandem unless the denominator, the thing you are measuring that high in, is the thing that's broken. And that's one of the things we'll talk about a lot on this show going forward, a lot on this channel. And if you've been in Bitcoin, I'm sure you've heard this, you probably agree. So make sure to smash the like button, leave a comment down below. Tell me if I'm making sense here, if I'm not making sense. And we'll switch into, we're running a little bit low on time. We've got about 15 more minutes. And I want to talk about one other thing here. Again, make sure to smash the like button, share the show, clip it if you think I said something stupid. If you think I said something smart, also clip that. And the last thing I want to talk about here, let me pull up the screen share, is the New York Stock Exchange is now allegedly they have developed a platform, their own blockchain to allow 24/7 tokenized trading of equities. So you can take your favorite stock and you can buy a tokenized version of it on this platform. It'll trade 24/7, 365 maybe. I would assume 24/7 also implies every single day of the year, unlike yesterday, for example, traditional markets were closed. This market will trade 24/7, and you'll be able to settle in stable coins. Now, I think the irony of the New York Stock Exchange developing a platform to trade tokenized version of equities is this. Crypto bros were calling for this a long time ago. But what they were calling for was that their platform would be the one that supports this. It would be Ethereum or Solana or Polygon. And the irony is that the New York Stock Exchange appears to have just built their own. We don't have too many details about it, but from reading their press release, that's the vibe I get. They didn't say, hey, we partnered with the Ethereum chain to build a whatever, or we partnered with Solana. The thing the crypto bros were calling for, what they didn't realize the whole time was these entities have the capital to build their own. Additionally, blockchains are a database. Is it the most efficient database possible? No, it's not, right? It's a trade off between efficiency and decentralization. It's a spectrum. And if you want maximum efficiency, you would use Amazon Web Services. You would use a centralized platform that could be faster, quicker, etc. And so everything that plays on this spectrum between efficiency and decentralization, you're going to end up at one extreme or the other. I don't think there's really much room in the middle ground for a quasi decentralized, quasi somewhat efficient chain. It's like you have Bitcoin, the most decentralized, most secure, least amount of trusted third parties or counterparties. Basically, there are none. You have that on one side, and you have Amazon Web Services on the other. The amount of chains that can exist in the middle, I don't really think there's going to be a lot. This New York Stock Exchange chain is going to be very close to the AWS side of the spectrum, right? You're not going to have immutable property rights buying tokenized equities on the New York Stock Exchange. Is it cool? Do I think this is an exciting development? Of course, right? Equities should trade 24/7. I would like to see third world non American citizens have access to US equity markets. That's what this will likely enable, right? Granted, they're not going to totally, gone with the wind are compliance and KYC, right? You're probably going to have to do some amount of that to buy equities. I don't think they're going to let just anybody just start wash trading equities via tokenized whatever. But it does open up the possibility that more markets will be able to gain access to the US equity market. In addition, I think there will be less manipulation possible with markets open 24/7. What we saw with Bitcoin being the first responder to the tariffs on these 8 European countries over Greenland, eventually, if markets are trading 24/7, we'll see every market become that canary in the coal mine, right? It won't just be Bitcoin as the lone wolf out there 24/7 on its own, being the thing that reacts immediately. So I think that'll be interesting to see how that dynamic shifts with equities being able to trade 24/7. I also am a little bearish on the concept in terms of volume and liquidity, right? We've seen that institutional investors, which again have the majority of capital in the world as institutions, they don't seem to be too excited or foaming at the mouth to use tokenized platforms, right? They all like IBIT, they don't like Bitcoin and cold storage. They like their brokerage account, they don't like a cold card or a seed signer. It's just what it is. I'm not saying it's good or bad, it's just what it is. So I think they're going to like their Morgan Stanley, Fidelity, Charles Schwab account rather than tokenized equity, whatever, right? That's just what it is. Maybe over the next 30, 40 years, over the course of my lifetime, we'll see that shift. We'll see equities become predominantly traded on chain. I don't think this happens anytime in the near future. All of the infrastructure supports the fiat system, all of the capital that is very accustomed to that infrastructure. I don't think it's going to be jumping off ship very quickly with haste. So again, this is cool. I don't think it's necessarily groundbreaking by any means, but certainly a step in the right direction. And ultimately, maybe one day we'll reach this world where we truly have decentralized finance. Everything is on chain. Everything is transparent and can be audited in real time. That would be cool. because one of the things that makes Bitcoin unique as a financial asset is on-chain data. It gives you like supersonic vision into how different market participants are engaging. For example, you can see coins that were bought 6 months ago, and in the aggregate, this is their cost basis, and they moved this amount of Bitcoin yesterday, and here's their buying behavior. Here's, all this, all of these very transparent insights into different cohorts of the market. You get that by having on-chain data. So if we were able to get that same level of transparency for every equity in the market, the intelligence and the opportunity would be through the roof. So that would be amazing to see. Right now, of course, equity markets are fairly opaque, right? If you have, I think it's $60,000 a year for a Bloomberg terminal, or it might be 60K a month. I'm not sure, but you have to have serious capital to get that real-time insights into equity markets. You're blocked out, right? There's a game and you can't play at the same level as everyone else, right? Us retail investors, we're a middle school travel baseball team competing against the New York Yankees when you're trying to trade equities because all of these institutions have real-time Bloomberg terminals, high-level insights into the market, high-level data immediately, and you don't have that. You don't get that. You're like me, you got to use TradingView and you get some data for or whatever, but you don't have the super hyper transparent real-time analytics into equity markets. That's why I like Bitcoin. It's a level playing field. Anybody can run a node. Anybody can analyze on-chain data. Anybody can take self-custody. You don't have to rely on a third party. If we brought that same level of transparency to the equity markets, I would be a big fan. I think this is a step in that direction. Probably won't happen in our lifetimes. Maybe mine. I'm only 25. I could see it by the time I'm 65. But I believe the majority of my listeners on YouTube are within the 35 to 55 range. Maybe it'll happen in their lifetime. We'll see. But that being said, step in the right direction. We're going to see equities start to trade on chain. And I made a kind of tweet and jest over the weekend about, yeah, I can't wait to trade a tokenized version of IBIT. Some people didn't seem to pick up on the sarcasm, right? But imagine this. You have Bitcoin, which trades on chain, blockchain asset. And then you take IBIT, wrap it in a security, and then you take a tokenized version of IBIT, rewrap it in a chain, and now you're just layering on the counterparty risk, right? So I'm not sure we'll see ETFs or any assets like that trade on chain. I mean, I'm sure we will at some point, but I would imagine they would have to start with just common stock, right? Individual equities rather than these funds, which are constantly rebalancing the holdings, and there's a bit more complexity to that, I would imagine, on the back end. But we'll see. That would be pretty hysterical, though, to trade tokenized versions of IBIT when you could just buy Bitcoin directly. So, with all of that, that finishes the show for today. Again, we have a huge research report coming out this week to everyone. So, make sure to subscribe to our newsletter. Link is in the description. It's newsletter.blockwareintelligence.com. We're going to be providing that transparent data on Bitcoin. We're going to be looking at on-chain data, seeing who's selling, because a lot of people say, oh, it's the OGs. It's not quite that simple. And so we've got a banger of a report coming out. Make sure to follow us on X, follow us on YouTube, download the report once it's live. We're going to be breaking it down on the show. Lots of high-level insights there that you will not get anywhere else. In addition, if you want to invest, or I'm not going to say the word invest. If you want to be a partaker of the Perpetual Bitcoin machine, we can help you do that as well. You can buy Bitcoin miners hosted with Blockware. You get access to bonus depreciation. And we have a partnership with Arch Lending. We call it Tax Shield. You can borrow against your Bitcoin with Arch. You buy miners with Blockware. You access liquidity of your Bitcoin without selling it. And you get a hard asset that you can depreciate and lower your taxable income, generate cash flow, stack Bitcoin. This is what the elites will be doing to build wealth in the 2020s. Between now and the end of this decade, you're going to want to do this at some point. Why not now? Why not while Bitcoin's only 90K? Catch this bull market, lower your taxable income, borrow against Bitcoin when it's down, right? Everybody's going to want to borrow against their Bitcoin 12 months from now when Bitcoin's 100% higher or wherever the chips may fall. Why not borrow when we're in a gully, when we're near a local bottom, which all indicators are pointing towards that. We have more data to support that in our report that's coming out this week. So again, make sure to stay tuned. Make sure to like, share the video, share the stream, leave a comment down below. If you enjoyed, subscribe to the channel, and we will see you all again on Thursday at 10 a.m. Eastern. Again, we're live every Tuesday and Thursday at 10, breaking down all things business, all things macro, finance, and Bitcoin. Thank you guys for watching.